Hi, everybody. Welcome to another version of the Bruce Singer podcast. We have a great guest today. Everybody knows Mike Fata. Welcome to the podcast. So I'm just going to introduce the podcast as first. Again, it's all about content, valuable content, content creation, focusing on the food and beverage space, the food tech space, the agri-food space. That's kind of our space. And I'm the host, and I'm also the CEO, CFO of Canada CFOs, which provides finance people and fractional CFOs to the same space as well. So I have a very exciting guest today, Mike Fata. Welcome to the podcast, Mike.
Oh, thanks for having me, Bruce.
Yeah.
I like talking about finance. So
Well, we're going to talk. We're going to get right into it. Mike needs no introduction. Okay. By the way, everybody knows Mike. He's got a fantastic book, a lot of good stuff. So let's get right into about finance. It's a big issue right now for a lot of food companies struggling to get raise money. Um, I think maybe we don't have a startup problem. Maybe we have a scale up problem. And that's just my perception. You know what I mean? So what can you share about your knowledge and your journey in financing? Let's get right into it.
yeah, I mean, I think it depends a lot of entrepreneurs struggle with like what they're building, having clarity on what they're building, because
Yep.
you can't go and properly capitalize your business if you don't have a clear plan. And it's hard to have a clear plan if you're in startup mode or it's your first time doing it. So unfortunately, a lot of entrepreneurs have built something that is maybe harder to finance. And then in more challenging times, economic times like now, a lot of entrepreneurs don't get financed. So I use the gold standard that I learned was like, if you could bootstrap your business, and bootstrapping it doesn't mean just you yourself. Like it can mean you, your personal finances, a mortgage on your house, your credit cards and stuff to get to like proof of concept with probably $1 million in sales, but a half a million for sure. That really gives you a good starting place and a good foundation to start from. Not everybody can do that. I couldn't do that. We had to raise capital before that when we started Manitoba Harvest, but I see it nowadays that if you don't really prove out your concept, it's either you're hard to raise capital or you're giving too much of the company away. So try to be scrappy and like finance through your own personal means or like really close friends and family that are investing in you as an entrepreneur instead of this crazy business idea until you get up to that kind of half a million or $1 million. Because by the time you get to $1 million, if you've done that right and you have density in like just a couple of different products and not that many retailers, it gets a lot easier to work out that growth plan of like what the next stage of growth looks like, and it looks logical, and then you could put a proper investment presentation together and maybe raise from some angels or some sophisticated industry investors. We got a great network of investors in that are interested in CPG and even natural and organic consumer products. But you got to get to that first stage. So I've done it all different ways. We started Mental Harvest with $10,000, maxed out our credit cards and then went to friends and family to raise capital, and then did get it over the million or a couple $1 million mark, and then we raised from I call it industry friends and family, like those sophisticated investors, but focused on the natural product space, and then raised venture capital and private equity. But that venture capital doesn't happen until you're, at least 5 million in sales. Nowadays, within hard economic times, when the investors pull back, it's more like $10 million in sales, before
Really?
you're ready to do that. Yeah, yeah, it changes. I've done 3 cycles of this in the 25 years I've been in the business, but like, it's either a founder's market or it's an investor's market. The last like 2 or 3 years, it was a founder's market. All these founders were raising capital at pretty high multiples, and there was plenty of investment capital, and interest rates were low, and all it just founders thought that was going to last forever, especially startup founders that hadn't been through it before. I just saw the cycle reverse, and now if you look just over a couple of years, investment rates interest rates really high, and less investment dollars sitting with the venture capitalists and private equity firms, and now they're holding a little more tight, right? They have the luxury of looking at a lot of deals, and the valuations are down on a multiple of sales for sure, and more businesses aren't getting financed, even some that have a scale. Like that's where we see businesses that get up to like 6, 8, $10 million, but they have a hard time getting new dollars in if they need it to become profitable, and it could be
Really?
like close
Even
the
at 6
doors.
million, even at 6 million, because I
Even
thought the bar
if
was
it's
like
built
five. Yeah,
if it's built the wrong way, right? Like five, if you're 5 million, if you get to $5 million, but your $5 million is made up of like too many SKUs, or too far of distribution, like you've tried to bite off Canada and the US, so you have these high sales operational costs. It's harder to finance that, right?
yeah,
Where if you have only a couple of SKUs and you have a density of like best velocities in a smaller amount of retailers, in a geographic region, it's a lot easier than to put those dollars to work. Another issue could be, and it happens a lot to businesses, like poor gross margin, right? Not
yeah, yeah, yeah.
having gross margins that are in like the 30%, or even some like less
Not
than that,
really
at
good.
20%. And then entrepreneurs thinking, oh, if when we get a better scale, our margin's going to go up, which a lot of times doesn't happen, because there's just as many headwinds that a business faces as
Yeah, of
tailwinds from scale by the
course,
time
of
they get
course.
there. And investors are smart and savvy. They've been through
They're
that
not
before.
onto that.
No, I'm not going to invest in a you could be making the best new fill in the blank kind of organic Pop Tart or whatever the product is, but if it's like 20% gross margin, the business is
Yeah,
never going to be successful,
like
right? So
like
see a
I
bunch of businesses
yeah,
struggling like that as well.
like I saw one person pitch, and the founder said, "Well, we're going to use the money to invest in equipment and automation, and we'll get our margins up." I could see I saw the body language of the investor panel. They've heard that nonsense. They've heard that before. I mean, there's some truth to it, but it wasn't a compelling. It wasn't a compelling argument, you know.
Yeah.
And it's funny. You're right, though. It's funny, They want what they want to see, and profitability too. I think is important.
Yeah,
Profit.
profitability. I mean, if you have strong gross margins, like 45, 50, 55% gross margin in that, I'm a 50% gross margin target, a true 50% gross margin off of, because the other issue that
Yep.
confuses a lot of entrepreneurs is like, what is true gross margin? Like, and some people calculate it different, but by definition, and I've been through all the way of having, paying accounting firms to do a quality of earnings report and really get into the financials. It's off of your net sales, so you got to take all your discounts in for your listing fees and
Yep.
your promotional discounts and anything like that off of your net sales, and then you're off of your cost of goods. So net sales minus cost of goods for gross margin. Some people take you off of gross sales, which is not right. Some people don't put in all their cost of goods in there, like they have warehousing costs below the line, or they have
Yep.
operational employees that they have in a wage line, is a kind of
Yeah.
very small business way
Yeah.
to organize. So that's why we have our a very standardized profit and loss template for consumer packaged goods businesses,
Yeah.
that I have on fatafleischman.org, just because I see so many people struggling with like what should their P&L really look like, and if you don't know, then you don't know. You go on to QuickBooks, and QuickBooks suggests the P&L, but they put some of the things below the line, and it'll print you a gross margin statement, but it's not a true gross margin of what the investors
Yeah.
and really what the CPG industry would base you on.
But investors will flush it out right away, anyways. They'll flush it out.
Yeah, ones that know what they're doing, for sure. Yeah.
Yeah, that's pretty cool. So what? So you're saying the bar is about? Well, it depends on a lot of factors. It's the 5 million or 10 million plus the number of SKUs. So how should they go about it? How should they go about? What's the best way to go? But let's say they are a candidate, because my perception is Canada's not the best for the food and CPG. Canadian
I
market
mean,
is
I think Canada has come a long way. Like there is a strong handful or two of venture firms that are focusing on better for you, like natural and organic products, right? From coast to coast, like Renewal Partners, Forage Capital, District Ventures or Venture Park, Investico, as well as the Crown Corps, FCC and BDC and EDC. So all of them are, $100 million plus kind of funds, and so Canada has the dollars there to invest in the business. It's just we don't have enough companies that are at the right scale. Most of the companies are, if they've created some success, are at like $1 million. It's too still small for these businesses to finance. But if you are a business that you get up to kind of venture scale, 5 million bucks, at least, 5 million going to 10 million with a
Yeah,
path to 10
yeah,
million,
yeah, yeah.
you need a strong, you need to think about it. I always like to think about it like, well, if you hired an investment banker to help you raise capital, which most can't afford to do because it's very
Yeah.
expensive to do that, right? Especially for a small business. How would they do it? You got to put together a strong 5-year growth plan, turn that into an investment presentation. So you're speaking to the investor about your growth plan, your team, your customers, your product, your innovation, the competition, how you're different, the capital that you're raising, the use of proceeds, how you're going to spend that capital, your historical financials, your projected financials. Like, there's a pretty standard investment presentation. And we make some of those templates also available at fatafleischman.org for people that are, need a free resource on that. And then you go and talk to all those institutions. Like, well, again, in Canada, there's only 8 of them or 9 of them. You should be going and knocking on the
Only a
door of
few.
all, right? And say like, hey, here's who we are, and then see if there's interest, because sometimes the funds are not investing because they're raising another fund. Sometimes they have a competitive product and it's not going to be a right fit for you. But you'll learn a lot. The entrepreneur and the business is going to learn a lot by having those conversations. And the conversation really should start before you want to raise venture capital. Like, if you think that you're the type of business that is going to need venture capital in the future because you're growing, and maybe you are a $2-3 million business, but you think, hey, maybe in a year or two I'm going to go and try to raise a venture round if we make it to the 5 million plus in revenue. Better to start those relationships now, because a lot of those
Good point.
businesses want to track and get to know the founder, get to know the business, get to see it from afar, maybe have some touch points before they jump off and really look at a potential investment opportunity.
And that's a very valuable point, because you can start relationship building even before you need it. And you got to look for a future cash pipeline at the same time. You know, you got to think of the future. But that's actually a good point, because you could learn so much. You could learn so much from the
Yeah. Yeah, I know, a lot of, founders can really start thinking about their, like, their you need a strong community, including that investor community, to really grow your business. Unless you came from a super wealthy family, most entrepreneurs don't start businesses and they have the capital to grow it
no, no.
all the way to a potential liquidity event. So always be networking, always be growing your personal brand. Use tools like LinkedIn,
I
go to
get it.
trade
Yeah.
shows and conferences, and meet these people and develop a relationship with them.
That's cool. Getting back, what I've seen is usually in the early stage, usually it's FCC, BDC, EDC. Usually it's those kinds of funds are available early on.
Yeah, I mean, the Crown
You
Corps
get
all have
beyond there.
different. They,
Yeah,
they, they, all those three Crown Corps in Canada have investment vehicles, but they also have other programs like debt,
correct, correct,
sometimes low
correct.
cost debt, which we use them all. I like the non-dilutive capital, especially if you're in if manufacturing, right? If you need to buy manufacturing assets because you're starting a facility,
Yeah,
best to finance those facility assets with debt, and hopefully a more friendly debt vehicle, which EDC and FCC and BDC have,
yeah,
and use your equity dollars that you raise for sales and marketing activities, for working capital, for innovation to really drive the business forward. So that's how we were successful. We had some great loan programs with FCC and BDC, and I think EDC as well. And that's what those businesses are really there for, right? That's why the government has them set up.
exactly.
And so, if people are in manufacturing and just starting out, that's a good way. What I don't like to see, because this can get you in trouble, is entrepreneurs that don't have manufacturing assets and raise debt too early, and they use the debt for working capital.
That's yeah,
If you don't grow, you're going to have a problem. If you have any issue with like a slower growth, or which you do when you're closer to startupville, it never goes
yeah.
as well as you'd like it, then you can find yourself painted in the corner pretty early for your business. And
You're
so
so true.
I'm not a big fan for debt for working capital until the business gets a little bigger and can truly factor that off of your receivables
So
and your.
because that's a big pain point, working capital early on. That's a huge pain point. So you're suggesting they go for like angel investors.
Yeah, you need a certain
That
amount of equity. Hey,
that's
if you start a business,
that,
if you
yeah,
start a business, you need a certain amount of equity in the business, right?
of
That equity in the early days is going to go to working capital because the more
course,
sales you generate, the more inventory you need to satisfy those sales, and the more receivables you're going to need to, especially if
of
you get
course,
into some of the
the large
larger
guys.
customers, right? And so going too early, which means leveraging your business, your balance sheet too early to too much debt, you could be growing and have an opportunity, but fail because you don't have enough equity in the business. So start with the equity and get enough equity into the business to really make sure that your growth is supported. And then after you become, probably $1 million company or something, then you could look at a factored line of because you probably at $1 million
Yeah,
a year company, you have about $100,000 a month in sales. And so you're probably going to have $100,000 of receivables, and maybe you have another $50,000 of inventory. You could probably pull $100,000 of cash in a loan, a factored kind of loan at
yeah,
that time. I
yeah,
wouldn't do it before that. I see again
yeah.
some of these the Crown Corps have programs where you get an entrepreneur say, I just started out, been in business 2 years, hit my first $200,000 in sales. I got this loan for like $150,000, for
They'll go.
working capital.
Yeah.
And no, you needed inventory,
Yeah.
or you needed equity to really get the business truly off the ground.
And what about, I want to talk about another topic too. Because when I talk to the some of the valuations, our valuations, they were out to lunch. That's is that what it
Yeah,
was?
for sure. It was a that was
It
back to my
was
comment earlier. It was a
it was
founder's market,
crazy.
right? So you had some people raising capital at like in venture growth, like or just in general, like 5 times sales, or I've seen like 8 or 10 times
Holy
sales, right?
smoke.
It's just crazy. And so it's definitely come back down because no one's going to raise money on that unless you're the unicorn business, which there always is still some, right? That's an outlier that has so many growth opportunities or so much IP or a moat around their business
Plus
that they'll
IP,
generate
yeah.
higher return. But the average in the market has come back down. So, I think it's generally for a good business that has growth opportunities right in front of it and has good fundamentals for margin and stuff. Two times revenue. If you're doing $1
That's
million
that's a good.
in business, maybe 2.5 times for a really good business. Maybe a little bit less than 2 times for a kind of Me Too kind of product. But if you're doing like, you know, $1 million in business, your business is probably worth $2 million if it's structured the right way. So,
Interesting. That's a
that's
good
what
rule of
people start
thumb.
talking about. Oh, I did $1 million in sales. I'm gonna go raise $2 million now.
Yeah.
You're like, well, maybe you don't understand. Your business is probably only worth $2 million. So the right move is maybe to raise $250,000 and use
Right.
that proceeds to grow the business another year. And then maybe another year you doubled the business and now you're a $2 million business. So maybe your enterprise value, your worth is like $4 million. Like that stages of financing is also important,
Right.
especially in markets like this, because just most founders aren't going to get funded.
No, and they'll learn the hard way anyways. If they go out and try to raise 2 million on that, the
You're gonna get laughed out of the room. Yeah.
I see people get laughed out of the room, and 6 months later, and actually I told them, I said, don't do that. Okay, you're weak. It's not gonna. You're not investable at that level. And they go on, and at 6 months later, they come back and they ended up where they should be.
Yeah.
You know, I've
Yeah, that's,
seen it.
that's why I put myself out there and give time to entrepreneurs or put out some of the material that I am just to give people context. I know I became a stronger founder and an entrepreneur when I learned the term market. Like, what is market? What's the expectation? What's the range that you can get on? And that's no different. It's not just capital market. It's like also, for CPG, like what's your expectation for sales in a category? If you go in and you start thinking, I'm going to sell 10 of these items a week in the store, and you're like, well, and you're a chocolate bar or you're a bag of tea or whatever, and you're like, well, how many does the store sell of other competing products in that category? And you're like, well, it sells two a week. And you're like, wow. if you know that the average is 2 a week that it sells of boxes of tea, and in your head you're thinking you're going to sell 10 a week, you're probably wrong, right? Like
Yeah.
when you go into the store and you start learning, oh, I'm selling
Yeah.
1.5 or 2 or 2.5 or 3 or whatever, it's likely going to be in that range. And so, as an entrepreneur, how can we learn like these insights of market, like what the expectation of valuation is, what the expectation of velocity is, and use that as we're strategic planning. That's why like peer-to-peer mentorship, like connecting with other founders that are in the space that are going through same things so you could learn some of those market kind of traits is really helpful.
So let's talk about, before we end the podcast, we're going to end very shortly. I'd like to talk about what you do. You mentioned peer-to-peer mentorship, and there's a lot of founders, they need help. Can you talk about what you do, and I'm sure the financing piece comes into play at some point in time as well. Can you just
Yeah, I after 5 years
yeah,
of doing what I'm doing now, I think I finally figured out my business plan and what
okay.
and what I actually do. So it's taken me 5 years, but I'm a venture investor. So I am just like an institution. I look for companies that are probably 10 million in revenue, have a good product market fit. And then I'm investing in those founders, usually alongside an institutional partner. So I do business with all the venture capital firms in Canada and a number in the US, usually investing alongside with them, and then help structure the governance, like structure the board and help advise the founders on building their team and all the things for the next level of growth. So that's where my area of interest is kind of in my day to day. Excuse me. But companies that are underneath that, I want to see all founders and entrepreneurs win. So I'm helping them in different forms. I do some coaching and advising to smaller businesses, probably in the $1 to $10 million range, smaller than it makes sense for me to invest, but I help them out on an hourly coaching basis or an advisement basis. But for a lot of those founders, I'm putting out my learnings and my materials. Either, I wrote a book, uh, Grow 12 Unconventional Lessons for Becoming an Unstoppable Entrepreneur. I do speaking engagements. I share short-term video content and share
Yeah,
my thought that way. I share a short form on LinkedIn. I connect with founders on LinkedIn. I do LinkedIn lives and LinkedIn audio. I have one coming up again this week. I've kind of been doing it when I can here and there once a month or something, where ask Mike anything. Like I
yeah.
I, I want to take the information that I learned and I want to see, that's more and more founders and entrepreneurs that are successful, because if you're in the natural products industry and you're becoming successful, you're helping make this world a healthier place. And that aligns really to my personal mission. So, helping bigger, higher end companies that are kind of well down their path, and then my give back time is in the form of mentorship, and mass mentorship I'd call it.
But
And
hopefully they'll get to the 10 million.
but some of them have. I thought
That's
of it
the
lately.
idea,
Like,
right? Yeah.
look at my portfolio,
Yeah.
like Margaret Coons from Nuts for
Margaret.
Cheese, wonderful founder.
Yeah,
I
was
mentored
awesome.
Margaret for a couple of years before I ever invested in the business. She's kept on growing, right? And came to
Yeah.
me one day and said, "Hey, I'd like your help formally." And same thing with Karen from Bloom. I knew Karen like 3 years before I made the mentorship, and she used to call me, here and there for mentorship advice. And so just like my recommendation earlier, like you want to develop relationships with investors earlier on, is always smart on the founder side. But anyway, that's how I spend my day to day on my family fund activities from an investment standpoint, and then how I'm helping entrepreneurs that are just too small for me to invest in right now, but I want to help be part of their success story.
Mike, this has been very insightful. I thank you for sharing about your journey, about the financing piece. This has been great. Whatever you're doing, and I see, look, I'm a fan. I see everything you're doing on LinkedIn, and it's awesome. And I've been inspired by a lot of your things you're posting there too, and it's great. It's great, and I
Yeah,
appreciate it.
thanks. Appreciate the compliment, and I'm glad we've been
I'm glad
talking
we
about
got
this.
this done.
I'm glad we had a chance to connect.
Exactly.
Uh, yeah.
Everybody, we'll get you next time on the podcast. Thank you so much.